So I remember when I started investing, I was under the impression for a long time that, for example, bonds are more secure than stocks. They were considered to be the less risky investment. And that was kind of the narrative when I was investing, right? So when I started anyway, right? So we're kind of taught, bonds are safer, stocks are riskier. So even when we talk about asset allocation strategies, or you'll hear, maybe the type of portfolio you should have when you're younger, they'll tell you take on more risk by taking on more stocks versus bonds. And as you get older, you switch that, right? Because as you get older, they're going to say, well, it's safer for your money if you have bonds, right? And I'm not going to get into the whole, some of the stories I've seen of bonds, defaulting. And of course, we have, cases where we may see stocks, companies delist, or stocks get suspended, or other things that may impact our ability to trade stocks. All right. So what I'll do though is kind of talk about some of the pros and cons I see of both, right? Because it's interesting, and as I work with my clients, and I'm coaching them, helping them to, understand investing, understand their portfolios and what they have, understand how to make decisions around investing, and try to help them to build wealth for themselves. I'm seeing this kind of narrative, right? So I'm seeing more and more persons go to bonds, especially in this climate, versus stocks. So I wanted to talk about that a little bit and just see how the conversation goes. I want to hear from you as well. Do you invest in bonds now, or stocks, or both, right? Let me know in the comments. Do you invest in stocks or bonds, or both, right? If you do both, then just comment both. But I'd like to know if you do either or, tell me why. Okay? All right, cool. So I wanted to share the article that triggered this video, right? So let me share my screen here. So we actually saw this article by our today, that the Mayberry, well, the MJE bond closes after being upsized, right? Oversubscribed and upsized, and it closed a week early. All right, so it's saying here that MJE was recently on the market for a bond. They tried to raise 1.5 billion, and the offer was oversubscribed, right? And they've had a couple of bonds done over the last couple of years. We've seen bonds by, who did a bond recently? I think VM did one, Barita did one. We're seeing a couple of bonds, right? And I know some persons that most of their portfolio is bonds, right? When we did the portfolio makeover challenge, there was someone with a healthy kind of allocation of bonds, right? So I know a few persons, well, where their focus is bonds, right? You get the consistent income and so on and so forth, right? Most interesting to me though, and I'll just, if you didn't hear about the offer, I'll just share this quickly so that you understand what was being raised and how much. So they had two tranches. They had 500 million being raised at an interest rate of 8.75, and then 500 million being raised at 9.25% if you are leaving it there for 23 months. So one was 13, one was 23, so on and so forth. If you want to learn about it, I think they did a review or an interview on Taking Stock where they were talking about it. All right, so you can learn more about it there. That's not what I want to talk about, the details of this. I kind of want to talk about why you choose one versus the other, right? So I'm going to talk about some of the reasons why you may choose one over the other, right? I'm going to talk about that first. If I would only find my screen. Okay, here we go. All right. So let me talk about some of the reasons why you may want to choose one versus the other, right? And I'll talk about what my preference is a little bit later, because I mean, I'm not trying to inject my own. I want to be as objective as I can at first, and then I'll talk about which one I prefer and how that strategy has helped me to grow my portfolio over time. All right. So what are some advantages of stocks? Let's start there, right? So higher potential returns, we know that. So stocks historically will outperform bonds. Bonds will typically have a fixed interest rate that they provide. Now, some bonds are tradable, and so that price that you're able to purchase the bond for may fluctuate. Now, sometimes you benefit by having that bond at a lower price than it was initially at, so you get a higher yield on that interest. Sometimes you have to pay more for it depending on how in demand it may be. Then we can think about ownership, right? When you own a share or a stock, you own a part of that company. A bond is meant to be temporary, right? You're going to repay that bond at some point. You are a debtor to the company. Once the company pays you back, they no longer owe you or have any obligation to you, and you don't own anything in that company. The next is dividend income, right? Now, conceptually, a dividend yield for a company can increase over time, right? So whereas you may have a bond, so we mentioned these 8.75%, 9.25%. Now, not all stocks are going to pay you a dividend that healthy, but a stock may, depending on your purchase price, get to that yield over time or maybe go past that, right? It depends on your purchase price. And of course, stocks will generally rise depending on what's happening in the economy. And so usually it's seen as a way to protect against inflation, especially if you're investing in growth stocks and they do well, right? Final thing I'll mention here is the liquidity of it, right? So stocks are generally seen as more liquid. You can get in and out, whereas some bond, again, if it's tradable, great. If it's not tradable, then you may be stuck trying to sell that bond for a while, and you may not be able to get back your principal unless there's somebody willing to buy that from you or the broker is willing to buy that back from you. All right. So that's the pro stocks side. So I'm going to talk about the pro bonds side now, or why you may want to consider that. All right. So one of the most obvious advantages here for bonds is that it's stable and predictable, right? And I use the word stable so loosely because it really depends on the issuer of the bond, right? And I can't stress that enough. There are some companies, of course, solid companies, they issue bonds. If you're looking for fixed income, go ahead. It's great for that regard. But there are some bonds we've seen, and again, I won't call any names in this video. I'll do another video for that. We've seen bonds default, right? And I've seen companies that have bonds that have defaulted go back to market after and try and raise capital, right? So I won't get into that right now. Bonds are also seen as lower risk, right? So they're seen as being something that is less risky than stocks, because stocks are known to have high volatility. They're known to be something that moves, depending on certain factors in the market, etc. Whereas a bond is going to pay you consistently that interest rate that was agreed at the start, right? That's how it's supposed to work. You will get priority from that company in terms of bankruptcy. So if a company is going to go bankrupt, their bondholders get priority for payment. Now, if the company is in bankruptcy, you may or may not be able to get your money. Again, that's something to consider there, but you will get priority, right? So usually there are some assets that can be liquidated, and bondholders or debt holders are going to get priority there. Bonds are seen as, the next one here is that bonds are seen as a sort of diversification for your portfolio. So the recommendation typically is that you get something that's fixed income, that's not gonna be subject to the volatility of the market, or that gives you something consistent that you can work with, that your income is gonna be more predictable, right? Especially if income is a priority for you. And then finally, it's really, I think, suited for persons who are income focused, right? Let's say you're earning more than enough, or your capital base is high enough where you can prioritize getting income and you're not necessarily interested in capital gains. Now, I do have, I can see where that would be something that would work for some people. It would make sense, right? So if somebody is, for example, thinking about retiring or close to retiring or is retired, they have a certain capital already and they just want to know, okay, I want predictably 5% or I want predictably X% for X date, then, you know, they'll work with that. Now, what I have seen and what I have seen is that usually the bonds that are of the higher interest rates typically are shorter term, right? The ones that are up the higher end. Now, there are some cases where you may get a good interest rate on a bond for 5 years, 10 years, 15 years, etc. But typically, the higher the rate, the shorter the term. In terms of, so even the Mayberry bond, for example, we're looking at that bond, that's 23 months. So if you do find the 9.25% attractive, in 23 months, you're going to have to find something else to do with that money if income is your priority. And depending on what interest rates are at that time, you may be able to go into another bond for a similar interest rate, or you may have to see, because if interest rates are down lower, then if Mayberry, for example, should issue a new bond, that rate is likely going to be lower now because it's always going to be competitive, comparable to where interest rates are at that point. All right. So, so I see here that, you know, Road Trader is saying that bonds aren't taxed. It really depends, right? It depends on how that bond is structured, where that bond is from. Because even in Jamaica here, you can purchase bonds that are US based. There are some brokers that will give you a portfolio based on US bonds, right? So it depends. That may have a different tax structure than something that's local, but usually they will tell you specifically if it is taxed or not, and if it is taxed at what rate, right? That should be a part of the documentation that you get. So let me see what Lawrence is saying here. So Lawrence is saying usually stocks in terms of, I guess you're saying what you invest in here, but I had something I needed cash for this year. So I put the money in a 1-year bond until July. I'll probably do more bonds if the rates continue to look like this. Lawrence, thank you for sharing this comment, because this is actually what I see, right? Persons will say, and I think this may be an ideal situation for most persons, how they think about it, right? Have something fixed, needed cash for this year, 1 year, you get X percentage. Because here's the thing, guys, and this is what I'll say as well. Anything being compared to just leaving the money in the bank will be certainly more attractive, right? So if you have, and I know persons with a lot in savings, high amount of savings and very little invested. I'm gonna do another video about that. But here it is that Lawrence had something specific, had the bond for 1 year, was able to get his money in 1 year, and I'm assuming he got, Lawrence, how much was the percentage? Like 7%, 8%, 9% thereabout? Let me know. Chances are it was somewhere around that range, especially if it was one from Mayberry. I think those are usually above 8%. I think Cygnus did a preference share, which was a similar, I think, between 8 and 10%, and so on, right? So it may make sense instead of some persons may see risking that capital for 1 year when the year comes, they need it, can't get it, versus putting it in something I know for sure I'm getting 7% or 8% in 12 months, right? That may actually be attractive to you if it is that you don't want to risk losing your capital at all. Now, for me now, and the thing that I would think about here is that it really depends, I think, on what the landscape looks like, what the opportunities are. So this is where you have to use your own kind of wisdom and see where you are, see how much you know about the market, etc. because I was having this conversation with a client, right? And I think this is a very, very interesting thing to say here. And I was having a conversation with one of my coaching clients, and we're talking about fixed income versus stocks, right? We're having this debate about it. They were talking about, you know, what they're seeing in terms of fixed income, what are some of the rates they find attractive. And I said to them, you know, again, as a coach, I'm like, these are the options you choose, right? But as talking to them and showing them a particular stock, we spoke about it. We spoke about some of the things that may potentially move that stock price and the impact XYZ. It so happens that when we're talking and having this conversation, 1 week later, we saw where the stock that we were discussing grew the very same percentage as the fixed income security that we were discussing. All right, so in 1 week, they're able to get the same return that they would have gotten from the fixed income for 1 year. And I use that as an opportunity again to talk to them and say, look, this is exactly what I was saying to you, that this is, so though the risk is higher, you have the potential for more upside, right? That goes back to the first point that I said, where stocks will give you a greater potential upside. Now, the risk is there for sure, but that portfolio allocation or that construct of your portfolio is going to be very important, because if you really want, sometimes I find where persons will go to a bond because of their absolute tolerance for risk and saying, well, I don't want to lose my money at all, so let me do this bare minimum and leave it, versus really surveying the landscape, look at what's there, learning about how stocks work, and then now you can say, well, let me see if I can get this potential upside. Because think about it this way, you have 12 months, or let's say 300 trading days in 1 year to possibly make what something in fixed income is giving you for the whole 12 months. That's how I see it, right? Again, you can tell me if you agree or not. That's kind of how I'm seeing it, right? By the way, let me know if you have any questions. I know I haven't done a live stream in a minute, but if you have questions as I'm talking about it, let me know, right? So Chairman was saying that MJE bonds are non-tax since it's registered in St. Lucia. Perfect, thanks for that. Road Trader was saying, I was listening to someone and the person was saying that you can retire off bonds like 100,000 USD and compounding. Can you repeat that statement, please? As in they put 100,000 or they get 100,000? Because if you have 100,000 USD, that's 15 million Jamaican dollars or 16 million. You can't retire off that. So you can't retire off of that. So that must not be what you're talking about, meaning they would have to have multiples more. Because again, if the best bond giving you 10%, that 100,000 is going to give you 10%, which is 10,000, which is 1.6 million, 10,000 US. You can't live off that, right? That can't, even the typical Jamaican bare minimum 1.6 million for an entire year is going to be a stretch, right? That maybe lasts you 3 months, depending on your expenses, 4 to 6 months, maybe. I don't know. It depends on your cost of living. But to live off 100,000, I'm not seeing that. So maybe you meant to say something else there, but that'd be interesting to see, right? There's a sovereign government bond for 9.625% that matures 2030. 2030 is 5 years away. When was it issued? Road Trader, let me know, right? So the point they are making here and trying to answer the question, right? Are bonds better than stocks now, right? That's the point of the video. Can we answer that question now? So I would say better, of course, is going to be depending on what you're looking for. Now, if you have a very low tolerance for risk, You want as close as a guarantee as you can possibly get for something, bearing in mind that there is no risk-free investment. So the bond promises you a certain interest rate. Bonds do default occasionally. Bonds will have issues with payments, etc. Right? So there's no absolutely sure thing in terms of investing, right? That is gonna get you though as close as possible to risk-free or low risk. If that's your preference, if that's your focus, then a bond would make sense for you. A bond would be considered better for you. But as I said to, and I was talking to the Young Investors Club, hopefully I got that right, at UA last week, right? And I was saying to them that you have to really consider, if you're starting investing, if you're a new investor, even if you're older in age, but you're just starting investing, if you have low capital, then a bond is gonna be, it will take, I think the rule of 72 says that it's gonna take maybe 6 years or so for that to double, right? If I'm using the rule correctly, right? But the point is, if you're able to get 8, 9, 10% every year and that compounds, and you're doing it for maybe 30 years, 40 years, that may make sense. If you're 40 years old, 50 years old, and you're 15 years away from retirement or something of that sort, you have to reconsider, because you have to really think about whether or not a bond would put you closer to your goal versus stocks, which are more risk, but they do offer more potential upside. And the higher the risk, the higher the potential reward. The lower the risk, the lower the potential reward. All right. So Lauren says that the bond for him was about 9%. It was a Mayberry bond. It was very attractive because of the no withholding tax. Now that withholding tax thing, that's 25%. That's something that's a tricky one, right? Yeah, I have some stories there. Road Trader is saying that they put that 100,000 in and reinvest back the return, so it compounds. But you can't retire that way, Road Trader, because if you need money to live, let's say that I am someone that is about to be retired, right? And I need 30,000 US, which is maybe 5 million Jamaican dollars to live. I can't invest 100,000 USD and live off that interest and keep reinvesting it. I'm not gonna have enough money, right? I would need maybe, if it's a 10% return, I'm gonna need at least 300,000 or maybe 350,000 USD to get enough cash to get me through, barring any unforeseen medical or emergency expenses. So that 100K is not enough. That 16 million Jamaican dollars is not enough to get started. All right. So I mean, I hope I answered the question. Let me know if I didn't, because in my head it made sense, but it might not have here. So you really have to choose as an investor which is better for you. At the bare minimum, though, I would say it's better to be invested than not. So I wouldn't go to the part of saying don't invest in either, right? It's better to take some risk than no risk, no gain. And you just have to choose whether or not that minimum of that percentage you're getting for the bond is better than the potential upside you can gain if you just simply learn how stocks work, right? I think if more persons understood stocks, if more persons understood how the market works, understands what drive prices, which industries to look at, what stocks to look for, then you can see similar, if not greater, returns than you would from bonds by focusing on stocks, right? Well, it's okay to do both, Road Trader. The purpose of this video is to kind of talk about them side by side. Certainly you can do both if that works for you. I know that would certainly be the recommendation that you would get by some persons to do both. In some cases, though, you may have a small amount of capital and you need to make a choice to grow that capital strategically, right? If you have limited capital and you do both, again, you're gonna risk potential upside because now you're splitting your investment strategy. That's a form of diversification. You should only diversify, I think, if you're trying to maintain wealth, not necessarily build it, because being too diversified too soon can pose a problem as well. But that's, again, another conversation, right? 100K in bonds is a no-go for retirement. Remember, most bonds only pay interest until you get back your principal. Stocks would make a lot more sense with what you're saying. I think you're talking about Row Trader there. But yeah, right? So yeah, hopefully that was helpful to somebody, right? Because I know persons are kind of thinking about the two. So I see a question here on Instagram. Are there any stocks that people with low capital can look into? Because it seemed like bonds are not for low capital people. Tiana, right? I get why you'd say that for sure, right? So the beauty about stocks, Tiana, is that you can pretty much start with any stock. Because remember, with stocks, and I'm not sure how much you know about stocks, Tiana, but you can start with any amount of capital you have, right? Because especially in Jamaica, where you can buy one share, and in the US, you can buy fractional shares. So you can buy 0.1 of something. Even for crypto, you can buy fractional amounts as well, right? So any stock would be available to you. What you need to do, Tiana, is know the right stocks to buy, how to do a watch list, how to make a short list for the stocks that you want to invest in. I can give you a kind of quick crash course here. There are three main type of stocks that we teach in our monthly program for you to look for. You either look for income stocks, those are dividend stocks. You look for growth stocks, those are the smaller companies that have massive growth potential. Or you can look for value stocks. These are the kind of blue chip ones, or the ones that are seen as undervalued, and those have the potential to trade higher if the market is able to realize that fair value for it. So three main types. And we have other types, of course, but we teach those three basic types in our monthly program. So I would say learn the basics first. Tiana, if you don't understand how stocks work, we have a beginner playlist here on YouTube that you can check out. It's about 7 videos. It'll take you maybe a half a day to a full day, 7 to 8 hours to watch everything, but you'll have a very good understanding of stocks after you watch that. If you want to learn a little bit more, join our community and you can learn some more there. All right. So, so Row Trader saying that was watching the Teach Me Odetta, and maybe I'm getting it wrong. She was saying that you can start with bonds young and it accumulates. Okay, I need to finish watching the rest of that video because I think I saw the video that you're talking about, Row Trader. Share the link with me, please, on one of these platforms or put it in the comments. I want to watch the rest of that video. I think I started it, but I didn't finish it. Now, if you're saying that Odetta was saying that you can start with bonds young and it accumulates for you to live off, again, I would say that really depends on the lifespan of that investment. Now, if you are somebody in your 20s and you're starting with bonds right now, and you have the discipline for the next 30, 40, 50 years to get that income, reinvest everything so that you benefit from compounding, you're adding capital to that each year and it's growing, it's growing, it's growing. That may work. That may work. Right? That may work. Awesome, Tiana. So Tiana, if you can't find it, message me on Instagram and I can send you a link. All right. But you're more than welcome to join our free community. We have a meeting coming up this weekend where we'll talk about the markets, etc. All right. And that will require a large amount. Exactly, right? So that's what I was saying here, right? So Lawrence, I'm happy that you agree with me. It's gonna take a lot, right? And that's the thing with bonds, right? So if you There's so much to pack into this video, but if you wanted to replace your annual salary, let's say your annual salary was 5 million. Now I know some persons don't earn that. Let's say it's 4 million, right? You have to have, if that 4 million that you need to get from that bond at 8%, you have to have your principal big enough for your outcome after fees, after taxes, to be that 4 million. So you need a larger pool of funds to be able to get something that you can live off of, right? So just bear that in mind. That means you need a way to grow your capital faster, all right? Okay, cool, right? So Tiana, I'll look out for you. If you have any questions, let me know. All right, guys, I'm gonna end this video here. I wanted to keep this one a little short, but let me know if you have any questions and I can take them pretty quickly, and then go from there. Road trader, that will only work if you have high capital and live in cheap economies such as Asia. But even though you would be scraping by unless the bonds pay really high interest. Yes, I mean, everything that I'm saying here is within the context of Jamaica. I don't know what other markets have, because I think in the US, the interest rates are a little bit lower, right? For bonds, etc. Because I think if you are getting something with 8% in the US, that would be amazing. So I think usually see like maybe 3 to 5%. That's considered the average there. For us, it's higher, right? So that's what you can think of there. And let me just do a check again, make sure there are no questions. All right, so let me just recap this very quickly here so I can close out. Now, the question is, are bonds better now, right? Again, depending on your risk tolerance, your ability to take on risk, I would say it depends. If you want consistent payouts, you want to choose your bonds wisely. Once you make the choice, you'll get that consistent income. If you want to grow your capital, if you're comfortable taking on more risk, if you understand how the market works and stocks works, then stocks are for you, right? So hopefully that helps you. Let me know what you think in the comments. Let me know if, again, are you investing in bonds or stocks or both? Leave me a comment under the video and let me know what other topics you want me to talk about as well. And I'll be sure to address them as we go on, all right? So hope everyone has a great evening and I'll see you in the next video.
Learning is the key to successful investing. And who doesn't want to invest in some way?
Here at L.E.A.R.N. Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at L.E.A.R.N. Grow Invest.